Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the man who's been promoted from mayor up to governor because he's buying an apartment building in the Austin area, which is the capital of Texas, the governor himself, Mr. Michael Becker.
Hey, Paul.
So Michael, who, as you know, has gone from being a loaner of money to being an owner of many multifamily properties, is a great expert on what multifamily is all about. So we always want to make sure we bring Michael into the loop. So Michael, thanks for joining us today. We appreciate that.
Glad to be here.
So tell me a little bit about what's going on in the Old Capital world these days.
So we're just now finishing up. We're actually in San Jose as we record this. I just finished up the meetup that Paul hosts with our buddy JC, the Northern California Investor Apartment Network meetup group.
Well, we jumped on an American Airlines jet. Michael jumped on a Southwest jet to come out to San Jose to visit with some of our friends. And these four guys, three of them are in the podcast today, live out in San Jose. They buy apartments in the Dallas-Fort Worth area. And these guys have been friends for a long period of time. We've had them on the podcast about 18 months ago. When they were on the podcast, they had 3 properties. Now they're just about to close on their 6th property. So unbelievable growth in the last couple years. And so let's get to know these guys a little bit better. Leading off in the center is Boris. Boris, thanks for joining us. We appreciate that.
Thank you, Paul.
Also, Oshi. Oshi, thanks for hanging out with us.
Thank you, guys. Good to see you here.
And then Albert, thanks for hanging out with us.
Good to see you guys.
And now who's not here is Leonid. So Leonid, who has moved from San Jose to Dallas, couldn't make it, but we wish Leonid the best. So you guys, before you became investors, you guys were friends, right?
Yes, we were. So I know Oshi since
The year
2001. So it's actually more than I know my wife. And we work for the same company. Actually, after we worked for that company in Israel, we ended up working for the same company in US. And I know Albert and Leonid also from the time I moved to the Bay Area pretty much, so almost 10 years.
So you guys all met just because you guys were all working in the high-tech industry, is that right?
Pretty much.
Mostly kids.
Yeah.
We met each other through the kids.
Yeah, so kids, same companies, yes.
So how am I sitting here in a conference room talking to you guys right now on an apartment podcast? How did you get from coaching a kids soccer team and working in IT to owning a bunch of apartments in Dallas-Fort Worth? What was kind of the genesis? How did you transition to real estate investing?
I guess now when we look back, it's kind of doesn't look so difficult, but it was pretty challenging when we started. It took us quite a time to establish what we do and how we do things. We started with real estate pretty long time ago, I believe 2010 or so on. And it took us time to realize that actually we need to move to the multifamily world from single-family homes. But I think we're at the point that we can continue to grow and actually make a living out of it.
That's good. So you guys started buying single-family houses in 2010, and you bought your first apartment in 2015. Is that right? That's good. So the first little deal you guys did was over in Garland. It was actually 2 properties you bought for 55 units. I know we had you guys on the podcast back about 18 months ago. I think it was in the spring of 2017. So if you guys, anyone listening to this wants to kind of hear a little bit more of the origin story, we talked quite a bit about that 18 months ago. But maybe just kind of quickly talk about the first couple deals that you guys have done. And then now, like Paul mentioned, you guys went from owning 2 or 3 properties when we interviewed you last time. Now you're buying your 6th or your 7th deal and much larger scale. So I thought we'd kind of talk a little bit about on this podcast about kind of how you guys scaled and what's different now that you've gone full cycle on a few deals. But maybe Yoshi, talk a little bit about those first couple of deals that you guys did, maybe this real high level brief version of how did you guys find those deals, and talk a little bit about kind of how you put those together.
So I think we started looking for an apartment complex back in February 2015 or something like that. And it took us a long time because we just couldn't, like, brokers did not take us very seriously. We were out of state, kind of like a out of sight, out of mind kind of thing. We didn't know much. We didn't know people. Then Paul came along and brought us this portfolio deal of 2 properties, 55 units total. So that was nice for a change, to make some progress. The deals themselves were not that great. We did many mistakes. We picked a contractor that, not necessarily did everything right. We paid a lot. We had some issues with the property management, but it has a happy ending. We sold it last year for a nice profit. So, all for the best. All happened for the best.
So how long did you guys own the 2 deals at Garland?
Almost 2 years.
2 years, good. And how long, so you bought those in 2017, and then how long from the first deal to get the second deal? How long did it take you go from 0 to 1 is always hard, so how long did it take you go from 0 to 1, and how long did it take you go from 1 to 2?
The second one we bought in 2016, so it was less than a year.
Less than a year.
And much of that time we didn't even look. We weren't ready to buy another one. But that's where Paul comes again. He pretty much brought us the second deal as well. So once we were ready to look for one, it went pretty quickly.
So let's talk about that second transaction. And Albert, what's the name of that property?
It's Arbor Terrace in Arlington.
Now, tell us a little bit about that. If somebody has never been to Arbor Terrace in Arlington, how would you describe the property? What age is the property? Does it have pitch roofs? Is it a chiller property? And where's it located in Arlington, if somebody doesn't know where Arlington is?
So yeah, it's a 69 product. It has flat roof, chillers, all the stuff that old properties have. It was in a pretty good shape, in okay shape when we bought it. So it's 143 units. Arlington is south of DFW side, and it's close to University of Arlington.
So do a lot of your tenants come from the university in and around that area?
No, I don't think so. We have maybe a few.
Okay. And so this property, did you get a brand new loan on this property, or did you have to assume the loan, and how difficult was that?
We assumed the loan, and it was pretty challenging because it was our first Fannie Mae loan.
Yeah.
And we kind of own few properties already, but besides the assumption, we had very little experience, so it was challenging transaction. But
you got it done.
Yeah, we got it done.
Yes, we did.
Yeah, so you assumed the current loan that the seller had, plus you did an assumption with the supplemental.
Yes,
Yes.
exactly.
Mm-hmm.
And so now you've had that property since
2016
2016, and now that property
is almost sold.
almost sold. So the property's under a contract. Someone's buying it right now.
It's an escrow.
Yes.
basically.
It's in escrow, and so it's going to be closing sometime
On 29th
29th of August.
of August.
Yes.
Yeah.
Fantastic. So not too bad. Has that transaction been a good one for you? Did you learn a little bit more about going into it, and talk a little bit about some of the challenges on that property too that you found?
Yeah, we learned tons. We learned about older properties that have their own issues. We had issues with electrical panels when we had to replace all of them.
What does that mean, Oshie? I'm going to talk a little bit about electrical panels, and properties that were built in the late 60s, early 70s sometimes had some problems with electrical panels. Tell us a little bit about what that means, and something that somebody who's never bought an apartment building, what should they be looking for?
So in the 60s or 70s, there was a company that went out of business eventually, but they created those panels, Federal Pacific, if anybody knows. Those panels are, I guess, prone to
Fires.
fire. Basically, the lender, when we were in the process of acquiring the property, the lender came up with this requirement for us to replace all those. And the first estimate we got was pretty close to be a deal breaker.
Because it's 142 units, and you had to replace 142 panels.
Correct.
Okay.
Correct. And so the first estimate, we were kind of like scared. We didn't really know what to do.
Yeah.
Eventually, it didn't turn out to be that bad. It was actually okay. We got further estimates, and they were more in line with what we could afford.
Yeah.
But yeah, it was scary.
So one of the things that you would probably warn people on, if you're looking for an older property, and that you could have aluminum wiring. Did you have aluminum wiring in this property?
No, it was copper.
So it was copper wiring, but it had the stab block
Yeah.
panels that were built by Federal Pacific. So one of the warnings for people who have never bought a multifamily property, talk with maybe your inspector, talk with your electrician, find out what kind of a panel box you have, and then talk with your lender to kind of figure out if is there any problems. Now, here's a property that was built in, say, 1969. And these warnings came out probably back in the early 80s that the panels. So the lender who's requiring this to be changed, they didn't require it. Now they're starting to possibly require the older these properties get. The concern really is that if these properties can carry a load. It wasn't a problem when the only thing you were hooking up your television into the wall or you hooked up your microwave into the wall. But now with the advent of so many different things people use electricity, whether it's your iPhone or you're using a DVD or you're using all kinds of stuff, there's a large load that gets pushed into the box. And sometimes it flips and sometimes it doesn't. When there's too much of a load and it doesn't get flipped, there's a large spark that happens and then it could cause a fire. So that's one of the things I would think that you would want to make sure everybody understand too.
So, Paul, I just remember that back then, lender told us if you can find 5 breakers in a property from all the panels that will trip, we won't make you to replace them. We couldn't find one. So it was kind of no-brainer that we understood we just need to do it.
And what are some of the other things that you were able to mitigate through? But you had an older property sometimes has asbestos to it. And asbestos is something that a lot of these older properties have. Fannie Mae doesn't have a problem with it. Some of the lenders don't have problems with asbestos on properties, just the way that these properties were built. But when you start to change walls or start to change things, that the asbestos has been encapsulated. And then if something gets wet and you need a change, sometimes you need to have special people come in and, say, mitigate the asbestos. Oshie, tell us a little bit about that.
So the problem came up. It's actually related to the electrical panels.
Yeah.
Because basically what the electrician needed to do is cut the sheetrock around the panel, take the panel out, and put a new panel in.
Yeah.
And that's where the electrician wanted us to test for asbestos. So we did. And they found just a little bit of percentage, just over the threshold.
Yep.
So we needed to do it right. We called in a mitigation company or remediation company. And basically they were cutting the sheetrock, and that's how the work was done. So it took a little bit more money than we expected initially.
Yeah.
But again, things did not turn out as bad as we expected, as we thought, as we were afraid of.
Yeah. So you got into the transaction without thinking you were going to have to change the panels to cut around it. You found out that you had to do it. You had to hire this company to do it. And then you had money set aside to get all this work to be done.
Yes.
All right. So tell us a little bit about, now it's a couple of years later after you bought the property. The property's been doing fairly well. It's in a good submarket, and you guys are thinking about selling the property. So you kind of fixed a lot of things. We're doing the loan for the person who's buying the property.
Yeah.
And what's good about that, I don't think there was anything
Yeah,
on the property condition assessment report that came
I think
back?
it was 0. So the only thing that came up, they have 7 fire extinguisher. That the date of last inspection was like more than a year ago.
Yeah.
So they asked us to inspect again. I never saw that kind of PCA report without nothing, pretty much.
Yeah. So anytime that there's a lender involved, sometimes they have an engineer go to take a look at the property and kind of figure out what the health and safety problems are of the property, things that have to be corrected today. Next 90 to 120 days, or it needs to be corrected over a period of time. So we're going to probably take money and hold that money to make sure that work has been done. But what I'm gathering, what I knew from that property condition assessment report that the engineer did, is that you guys had a number of things when you guys bought the property from the previous seller. Now the new buyer who has that report to be done, the things were not complete, or everything was done. So you're kind of turning over a very clean property to the buyer. So you guys have put money back into the property. And a lot of these properties, the investors just think that they can pull money out all the time. But I think what you're indicating to me is that you've put money back into the collateral. And that's made the property perform better, so you can actually get higher rents down the road, because you're going to have tenants who are going to stay in that property a lot longer. So that's a big thing.
Yeah, so really kind of moving forward here now. So when we first talked to you guys about 18 months ago, you had about 200 units in total. And since then, kind of we were talking about all the stuff you've done. You've done almost 700 units since then when you close on your next deal that you're currently working on. So maybe kind of talk about how you evolved. So you've gone from doing these smaller, older deals and looks like you're buying bigger, better, newer properties with the most recent acquisition. So can you first kind of maybe tell me why have you guys went from like the 60s and 70s up into the 80s and going from 50 unit properties to 200 plus unit properties? What kind of motivated that?
So I think that asbestos issue kind of explains it. And also we had to replace a bunch of chillers. One of them was actually, Murphy Law that went down in the middle of summer in July. And like 50 tenants without AC when 110 degrees outside.
On a Friday late afternoon.
Yeah, on a Friday late afternoon. City was there next day. We started to get fines. So all this happens on those older projects. And basically, we just knew that eventually we want to buy a newer product with less maintenance and better cash flow and everything.
Yeah, so like what I like to say, you have all these older buildings, you have all these non-recurring expenses that recur all the time on these old deals. So, and then what's I think kind of the nuance to the business is what people that are kind of newer in here don't understand, that these expenses are capital items, so they're below the net operating income line, so it doesn't impact your NOI. But your electrician wants to get paid in cash, so it's actual cash expense. So you have to, if you don't have money set aside and budget for it, it comes out of your monthly or quarterly distributions to your investors. So these newer properties, the 80s stuff that have, aluminum wiring and individual HVAC units and individual water heaters, they don't have a chiller going out in the middle of July because they always go out in July in Texas. So it's good. So you bought 2 properties since then, or really I guess it's 3 properties since then, and you're working on 1. So maybe talk about it. So one of the next deals you guys bought was a 2-property portfolio. I believe they're both 80s deals. Maybe kind of talk quickly through what attracted you to those 2 deals and why did you buy them? Albert, maybe.
Yeah, it was 282 built properties in Segoville and DeSoto. They're pretty clean, so we like them a lot. It's newer properties. They have pitched roof.
Yeah, the seller had owned that property for, 20 years?
Yeah, they held it for a while. Yes.
So they weren't just flipping the property, and they weren't trying to walk away with a big bag of money only for a short period of time. But they owned it for a long time. And that's what we love, is these owners that have owned these properties for a long period of time.
So I think that also interesting how we got that deal, because what happened actually, it went on the market, I believe on Monday or so. And Leonid, our partner in Dallas, he was there next day meeting the owner, Doug Ross, and they walked the property. And the same day we submitted LOI. And he just took it off the market. So essentially it was off-market deal because we never competed with anyone pretty much.
I would also like to kind of key on, you got 4 guys in a partnership like this. And, we buy these deals right now in partnerships. There usually is not a large guy that has a ton of money. It's usually a couple of guys that kind of manage or run the partnership. Then you have a bunch of investors that put their money into the deal. And I think one of the reasons why you'll be able to scale up quickly is you kind of define what your roles are. So Oshi, tell me a little bit about the role that Albert has in your partnership. What does he do?
We call him our CTO. He's the technology guy. He's doing a lot of work on our websites and automation and tools and stuff like that. And
Boris, tell us a little bit about what does Oshi do?
So Oshi, basically it's Oshi and me. We just mostly concentrate on next property that we're going to buy and operations of the current project. We kind of left High Tech Vault, so our day work starts at 9 in Pitts, Santa Clara, and we meet every day and we sit and we open Resman, we look on P&L, we look on the bank accounts.
So Resman is your software that
yes.
you guys all have access to, that you can get in and kind of see what bills have been paid, what your occupancies, and where all the expense items and how much income is coming in. That's Resman.
Yeah.
And tell us a little bit, Albert, what does Leonid do? What's Leo do?
Leo is our foot on the ground in Texas.
Yeah.
So once we get offer, like a deal that is going on market or off market, he takes him 2 hours to get there, take a look, walk it through, and give his opinion, take pictures, send videos.
So it's 4 guys. Leo's on the ground. You guys are out here in San Jose. How many of you guys have full-time jobs, and how many guys are full-time investors?
It's just me and Oshi, full-time investors.
Okay.
And I have full-time job.
And Leonid also work at Amazon still in Dallas. And actually, Leonid's wife, Anna, she also started to do much more with helping us to communicate to investors, all the legal documents and bunch of stuff. So it's a team sport.
So being a team sport, you also need to make sure that you have a good reputation out there, that you're closing on time, and then you're with the realtors that are actually offering these deals. How did you find the Cedar Point and the Thorn Manor transaction? How did they bring the deal to you?
So this actually was not an off-market deal. That was an on-market deal, but then Leonid was there, and it became sort of off-market for us the next day because we were there so quickly, and the seller just took it off the market.
Yeah.
Once we.
So, and then you were able to perform on a timely basis, and then your reputation of performance gets around. People like to do business with people.
Apparently.
The sellers want, and so for the period of time that you guys closed the 2 Cedar Point and the Thorn Manor, when did you get Running Brook under contract, and how did you get that deal?
So Running Brook, it was in 2017. How exactly did we?
It was
Sorry. I'm getting confused with all the properties. It was in 2018. We just closed
It was
that.
April 2000.
It was a marketed deal. We went through the full cycle. It was like 10 or 11 offers on the property. And, as usual, it was first round, second round, and final round. And eventually we got it. But the property that we are working now was brought to us by the same broker. And it was pretty much off-market deal that he wanted to talk to us first because we executed on the previous one.
So having the ability to have a good reputation out there with the brokers is important, but also having a good reputation with your investors. Tell us a little bit about how you get your investors. Who invests with you?
So first 4 deals, it was just 4 of us, no passive investors at all. Next one, it was already 22 investors, and mostly friends and family. On the next deal, in parallel, we also started our own meetup group, which we have here on a monthly basis, and Paul was there a few times, and Michael actually was there also. And right now this group is grown to 700 people. So that's one source of investors. And also people that get to know us, they tell their friends, and friends of the friends, and that's how it's growing, basically.
It's kind of organically grow. So yeah, it's been pretty good to see you guys, your growth since I first met you guys to kind of where we are today. You certainly have scaled up quite a bit. So some of the themes that I heard you talk about are some of the things that I believe in. We talk about all the time, or people do business with people they know, like, and trust, and brokers like selling deals to people that make their lives easy. So it's not always about price. I mean, price is obviously important, but it's about execution, a certainty of execution, and not being annoying to them, and just kind of doing what you say you're going to do. And so what I've seen a pattern from what you guys just described is that you bought a marketed deal, and then that same broker brought you an off-market deal shortly thereafter, which means that they enjoy doing business with you. So that's something I think people can take away. Then the other thing is just really, you partner up with other people, and how do you share roles and responsibilities, because it's a team sport. And then as you scale, I'm sure you're having more time needed to communicate to all the investors about what's going on with the project, process distributions, process K1s, things like that. So how do you kind of scale that? And now you're bringing on Leo's wife, and she's helping with a lot of that stuff. So, I mean, these are all just kind of common themes that I've seen you guys do it, and going from older, smaller properties to newer, better, bigger ones. So these are all kind of very similar themes that I've seen a lot of other successful people do. So how are you guys thinking about it now that you've been in the market in Dallas-Fort Worth for, I guess, a little bit over 3 years now, and doing real estate for 8? We've been on an unbelievable run from it. So how are you guys seeing the marketplace right now, kind of in general, and how are you guys kind of structuring your deals to mitigate some potential downside risks?
I think the market was really great to us, and probably to everybody. But, we're coming from Bay Area, where the rents are ridiculous. And really here you can see that it hit affordability barrier and it's not moving, even declining. I don't think we're there yet in Dallas, especially if you can find some deals with rents still below the market, and we're still being able to find those. On a risk assessment, we just, all the properties that we bought recently and moving forward until something changes, we just take 12-year term, 30-year amortization loan. We usually get some interest only for a few years. And what we like to do when we analyze a deal, we like to analyze a deal in a way that we just want to survive like 3-4 years of downturn and being able to pay our bills. And we know if we can do it and property can support it, being on a long-term loan, we will be okay because downturns tends to be shorter than upruns, so hopefully it will work out.
So you guys are certainly taking long-term fixed-rate debt and setting aside capital on the front end of these deals, kind of implement your plan, cure any deferred maintenance. You're buying newer properties to kind of eliminate some of these chillers going out in the middle of summer, so these large non-recurring expenses that happen all the time. What about leverage? Are you guys taking a little lower leverage? I know that's kind of generally one of the themes that Paul's been talking about. Some of the lenders have been kind of cutting back a little bit on the leverage. Have you guys experienced that as well, Oshie?
Absolutely. Absolutely.
Yeah. So the first couple of deals you did, what kind of leverage did you typically get, and kind of what are the most recent ones you're looking at?
Much closer to 80 than today. Today it's 70, high 60s. Something like that.
And so the first couple of deals you did with your own capital, as Boris just said, but what are your investors expecting? What do they need to hit from like a rate of return perspective to make it an investable deal? What's kind of the requirements out there in your circle?
So our deals, like typically we would look at a deal if it can show a chance to get 7 to 9% over 8 years period.
Cash on cash?
Cash on cash, yeah. And double the value, the investor's value in up to 7 years.
So your investors, are they mainly just cash on cash driven, or do they look at like an IRR, internal rate of return, or how do you present it when you're presenting the investment opportunity to them?
So we do cash on cash analysis, and we also do value analysis, or rather investment, like multiplied investment over up to 7 years.
Got it.
That's the deals we're trying to focus on.
Yeah, good. And then I know one of the things we talked about before we started recording was when you guys are looking at these deals, you have a going in cap rate, you have an exit cap rate when you're kind of doing your hypothetical analysis, and you're looking to expand the cap rate. So maybe talk a little bit about that concept. I know that might not have been what you guys were doing when you first started, but I don't know, maybe Albert, talk about why you guys are expanding the cap rate on the exit to compared to the purchase.
Yeah, currently all the cap rates are compressed, so we don't expect them to go down. And so our models that we do, we increase the cap rate by 0.25% every year, or 0.2% every year, and it's kind of our model for predicting how much we will be able to return to our investors.
Yeah. Now, when people want to invest into transactions with you, and again, past performance is no indication for future returns, but everybody asks me, Paul, what type of waterfall? How do investors get paid? Are you able to kind of share with us in just round numbers? How do you pay your investors? How is that done?
So typically what we do, we have waterfall structure on all our deals, which means up to 7% on the cash flow side, up to 7%, everything goes to the investors. Every dollar above 7% is split 25-75. When we get 25% and the rest go to the investors, and 25% is basically our bonus. And we also invest typically our own money in all our deals, so we also get paid as investors. And when we do sell the project, basically first we return initial capital to everybody, then we pay all the bills, mortgage, and remaining balance is again, and it's split 25-75. So 75% goes to all the investors, 25% again, it's our bonus.
Yeah, so I like to have people kind of explain a little bit about how their splits go with the proceeds. So thanks for kind of sharing that idea, because there's different ways of structuring these transactions to attract capital, and people can always ask us, what does that mean, how that is done. Let's go back to that one property, that Running Brook property, and I thought it was kind of interesting. You guys had, before you bought it, 2 fires on that property. Tell us a little bit about that. So even before you buy the property, you have not two units down.
No.
You had two buildings down.
Yeah.
And tell us a little bit about that and how that happened, and how'd you work through that before you even closed the loan?
So we know for sure what happened in one of those fires. It was domestic violence type of thing.
Uh-huh.
The second one, we think it was something similar, but an official report we never were exposed to it, so we don't know for sure.
So how did you mitigate you still had to fix and repair those units. How many total units were the 2 buildings?
8 in each.
8 each. So 16 units were down.
Yeah.
And now the lender who wants you to take over the property wants to make sure that all that work is done. So how physically was that done?
So it involved some sort of escrow, and the title company were also involved in this. Basically, the seller had to put some money aside, put it in escrow with the title. There was some sort of an agreement with the lender also that involved us, the lender, the title, and the seller, that the work will be done within the next couple of months. And by the time the work is done, the title company is going to distribute the funds to the contractor.
Mike, you've had a fire at your property or two?
Yeah. So you can't. One of the things I like to say is you can't own a lot of apartments without a couple things or 3 things happening. Your tenants will sue you. People will die, and there will be fires. So there's always fires, and domestic violence fires is a new one to me. But like grease fires, electrical fires, someone was smoking a cigarette and put it on some leaves, that was a fire. So yes, there will be fires for sure. And like you mentioned, usually there's some sort of escrow around it. Generally, the seller will have some insurance proceeds that will cover it. They'll sign the proceeds and credit you their deductible. It's usually typically a pretty good resolution to that, but that obviously will impact your loss runs. They'll go in your loss runs and impact your future insurance rates. So I don't know if you guys noticed that or not, where your rates went up.
Yeah.
So I think insurance was a big issue because we found only one company that was willing to even insure the property. So it was more expensive than we usually pay, but also it was a challenge to find that provider that will insure it. And also I wanted to mention that really I think lender did a great job on this, because it's not straightforward at all to land on a property with 16 down units, and contractors that not ours is actually working there. So
yeah, that's the benefit of an experienced mortgage broker, to kind of work through stuff like that. And not all transactions are easy. So a lot of them are, and I'm sure you've had 5 easy ones and 1 hard one along the way, or maybe you've had 2 hard ones. That sounds like the Arbitraris deal was a little challenging as well, but. I think that's just a testament to the guys and them kind of working through and being diligent and growing. So it's been a pleasure to see you guys kind of grow from where you started to where you guys are. It's been great. So I don't know if you have any kind of last little nuggets or words of wisdom that you've kind of experienced and some things that you wish you knew when you started to where you are now, and kind of what would benefit someone who's starting out on kind of thinking about how do I scale my business and how do I not be like a one and done? How do I become successful and actually run a business?
Well, one thing I cannot put enough emphasis on is the reserves subject. That can be a killer if you don't have any or too little, and it can definitely make a big difference if you do. So whoever wants to start this business, just have a lot of reserves.
And maybe I will just mention that I wish we would start with multifamily back in 2010 instead of buying single-family homes. Not that they didn't do great, but I believe we would be much better place if we bought several properties back then.
Albert?
Yeah, and you can find us on wellsgrowinvestments.com. We have a website. You can contact us if people interested.
Again, what's that website again?
wellsgrowinvestments.com.
Can you spell that for me? WEALTHGROTH. Yeah, investments.com. All right. So, guys, thanks for hanging out with the podcast out here in San Jose, California. We appreciate your time. Oshi, thank you. Boris, thank you.
Thank
Albert,
you, Paul.
Thank you, Paul.
And Leo, sorry you couldn't make it, but we'll see you back in Dallas Michael, thank you. Appreciate it.
Yeah.
I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.